Climate Investments was originally founded by an organization called OGCI, the Oil and Gas Climate Initiative, which was funded and put into play by the 11 largest oil and gas companies. So Exxon, Chevron, Shell, Total, everyone in between. And that was done in 2017 in an effort to really produce a venture capital fund of a reasonable size to actually help decarbonize not just the conventional energy industry, like the oil and gas industry, but also decarbonize through carbon capture, through CO2 and energy efficiency, and then also waste to value and all the other things that you folks at TDK do and care about, we cared about. A few years ago, we began an initiative to actually separate OGCI and CI. And so now CI, as Climate Investment, is actually an independent fund manager. So we're finishing the deployment of the first $1 billion impact fund, and we are raising 2 new funds, a growth equity fund and a new impact venture fund. The growth fund has had its first close, has not made its first investment yet. And then the second, what we call Catalyst Climate Fund, will be open for business in 2024. I remember back in the Clean Tech 1.0 era when we, and I and others, were first starting to do this sort of energy investing. And there were a number of challenges with that. It was new, as a new sector for venture capital. But one of the things that was really apparent to us is that the capital structure, infrastructure for stages of risk capital, from seed stage to venture to growth to private equity and then to public markets, was not robust and comprehensive. So a startup could raise its money in early stage with great investors and then run out of capital providers by the time it got to scale. And so now 20 years fast forward to climate tech, there is abundance of capital at almost every stage. So we find then that financial infrastructure to be solidified now. Now, will we go through ebbs and cycles of there's more venture and less private equity, or the public markets will lose their appetite and then it'll come back? Of course, but the overall, I'll say, hedge of capital that's available is in good stead. And TDK, as you guys have now launched, I think, Fund 2 and you've deployed on Fund 1, you guys are a natural partner for us as we do a little bit larger check sizes. You guys have great technology chops, great business acumen, and now growing sophisticated venture acumen. A great model for us to either join you at the next round, or maybe, as we do our new fund, step in with you and co-join you at that first round. And what we'd like to advertise to our entrepreneurs, which I think TDK would like about us, is we've intently set up our reserve allocation so that we can argue to an entrepreneur that we can be their capital for their entire journey. So I don't want to not miss out on a mezzanine round or a Series E just because I joined you guys on the Series A. And then that makes us a good co-investor for you and you a good co-investor for us. I thought all the panelists and panel moderators were really good. And the TDK Ventures team did the bulk of the work today. I think some of our team is going to do a little bit tomorrow. Panel moderation, getting the panelists who are really insightful to actually say provocative things, right? Not just, here's my playbook, here's the ABCs of what I do, but to actually tease out their vision or their glimpse of the future. That's where key moderation really helps. And I think you guys did that really good. So for takeaway today, I love the panelists. I love the 5-minute, 5 CEOs. If I can hear 5 pitches in 25 minutes, it's a rarity, by the way. That's really good. So I always like that at the end, right? Because it's a nice takeaway for us as investors. It's also great for those entrepreneurs because at the very end, when you go to, say, beverages, they've already now made that introduction one to many, and then they can go find a place to have a collaborative discussion. And then the third thing that I thought was an interesting takeaway is we're a bit larger than you guys, so we have but we have practice groups in the US and China, and of course here in Europe and London. And this UK ecosystem of climate tech investors is growing. I mean, there's some big players, and my third takeaway was that you guys came all the way to put your boots on the ground here in London. I think that's fantastic. First of all, London, is one of the top 3 or 4 cities for capital, and has been for hundreds of years, right? So the practice of how do you actually fund things, whether it be climate or others, has always been here. I do think it's an island, and all islands have a very conscious view of where do their raw materials and resources come from. And when you live on an island, you think about how you treat the resources a little differently. So I always think that the UK, getting off its coal legacy from Scotland and Wales to Manchester, is now reindustrializing around a new initiative, which I think has great promise for wealth creation, great promise for a better planet, and great promise with a country that can put some IRA type policy behind it. So I think, you could argue that Paris and Zurich and other great cities in Europe are also useful candidates, but I think London is an international city, great capital access, and my first venture fund, BP, courtesy of Lord John Brown, was my first LP in my first venture fund. So there's some DNA in there from the clean tech era as well. I had not even looked at TDK as a company until I met you and started talking to the TDK Ventures teams. And I got initial exposure as you and I spent time together, and your team and I spent time together, at the evidentiary support of how diversified TDK is as a company. So whether it's TDK Ceramics or TDK Memory or any of these different things, you don't often see the breadth and depth of the things that TDK as a company owns, touches, and does. And I was really impressed by that. And what I saw as evidence of that is when you would take an opportunity to invest back to one or more of the business units and to the technology teams at TDK, I was actually quite impressed at how quick the turnaround for that analysis was. Because you see a lot of corporate venture firms, when they have to go back for some business unit approval, can be an exhausting process. And to me, it seemed like it was very athletic for you guys. And whether you guys were doing something interesting in novel sort of semiconductors or fuel cells or whatever it might be, I was impressed at how that cadence of we like it, we don't like it was for you guys as a firm. If you're a corporate VC that has got one core business, produces all your gross margin, all your net profit, and you want to diversify and use venture capital as a way to diversify, you will start looking at investments that are so antithesis of what you've done as your core, so you don't have a way to opine on it, right? But if you have 25 different verticals, you're always going to find something that is adjacent enough to one of those verticals to get an opinion. The fear, of course, is that you don't want to feel like that the venture platform becomes a threat to those businesses. And that's always a challenge with corporate VCs. But because I think if you look at TDK's diversity, they've had businesses go up and down, and they've acquired businesses. And so I think there's a much more dynamic, prototypical architecture to what TDK does. This business, despite Google Ventures trying to use an AI engine to pick stocks, or despite others hoping that you can do these things virtually, is a human capital business. It's human capital because the best venture capitalists get the access to the best entrepreneurs. And the best entrepreneurs can take their money from anyone. One thing the best entrepreneurs want with their money is not just the technical credibility, not just the organizational support. They want the relationship. Because my old rule of thumb, right, was that you want to be the VC that when the CEO calls on a Friday night and he says, my finance guy is cooking the books, my sales guy's inflated the forecast, my head of HR is sleeping with my head of marketing, and my dog just died. Your response as a VC, if you have the right relationship, is, I'm coming over right now, or I'm buying you breakfast and we'll work this out in the morning. And so the human capital side is about access to great entrepreneurs and then those relationships. That extends into the board, it extends into your co-investors. So having an event like this where you can have entrepreneurs that you might be interested in investing in, co-investors who you would like to work with, and fellow board members who you have to do tough governance things with, requires human interaction. And so human capital is that human interaction. So more events like this are probably the best recipe for us, especially coming out of a pandemic. I learned that Gianfranco invested in Fisker the same year I invested in Tesla. So, and
that's cheeky.
I know, it's cheeky. But the funny thing about that is it's evidence that our business still needs a lot of luck. And at the dawn of electric vehicle investing and revolution, you could have decided to invest in Think or Fisker or Tesla or a few others. And I remember we put 20 million into Tesla and bought 22% of the company. I led the Series A. And I remember there wasn't room for people who wanted to invest in Tesla in that round. So they went to Fisker because that was the other choice. But I remember when they invested in Fisker, firms like Kleiner or Gianfranco, and personally, you couldn't have judged them as one's going to win and the other's not going to win. That was not possible. So I learned that he invested in that. I'm really excited about his electric high performance Italian startup. But I think it's fascinating. History is such a guide for what we do because our job is to actually try to project the future, right? And it's usually not something you're going to learn from McKinsey. It's usually not something that incumbents were going to tell you. It's usually something that's probably more appropriate that a science fiction writer might tell you. And our job is to underwrite that and handicap it from a timing perspective. And history is probably one of the best guides for us to use as a telescope to look ahead. And so if you think about Tesla, I mean, it really started in 2002. So yes, the company ships a lot of EVs, but it's a 21-year-old company now, right? Fisker tried to get there, went Chapter 11, came out of Chapter 11, and now it's doing well, maybe owned by a different company. If you and I were looking at an investment today, maybe it's one of these catalyst companies that we saw in the pitch. I think there were 2 or 3 companies that were specializing in catalysts. To look at things like, well, they're fundamental material science issues. Question, can you make the catalyst and can it be affordable? And then does the catalyst convert a CO2 or some other gas into a higher valued product? And all that could be vetted, and we could bring TDK Ventures teams in and CI Ventures team. We could bring our respective technical teams together and really go check, 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 and look at IP and check, check, check. But the real challenge would be, how do they get to global scale? And how long will that take? And how much capital is needed to get the company the oxygen to get to that scale? That's when you need the telescope, because then you're going to look down the road 10 or more years, and you're going to say, well, who else is going to attack this problem? In what way? And how do you handicap them as competitors? And then you're going to say, what do the incumbents do? You know, I always sort of ask this one question when we do diligence, which is, when you're successful, what is the behavior of the incumbents in the marketplace? Oftentimes entrepreneurs say, well, they're just going to buy us for a lot of money. I go, maybe, but what if I'm an impact investor and my LPs care about impact, and a big incumbent company sees you as a threat and then pays a lot of money and makes all the investors happy, but then buries the technology and never goes to scale? I don't get to deliver on my impact. Maybe we deliver on the financial. So the telescope for me is looking out there in a world where we can't see much beyond our windshield anyways. You know, I would say like ventures, like driving in a fog with the rain and the wipers can't keep up and you're trying to look down this road, your headlights are blurred. That's our job, is to look past that and see what might be that 10-year forecast. It's really hard, but it's also the fun. It's also the fun. Yeah, that's it. Actually, that's a good question. Here's something I have often said, maybe never in public, but if you remember the John F. Kennedy speech about going to the moon, he said, you know, in the United States, when he was talking on national TV, he said, we choose to go to the moon not because it's easy, but because it's hard. That's what he said. And what I've said about venture capital is, we choose to do venture capital not because it's easy, because it's a lot harder than we thought it was. This is my version of the JFK speech. I think if you've never been in it, it looks easy because you get You get press reports and financial of the things that win. Nobody looks at all the stuff that doesn't win. And our batting average, if I use a baseball analogy, is really pretty low in our business. I'm hopeful, you may share this opinion, that as we do these more industrial things, we're not in the white space areas, like in trying to invent cellular infrastructure or something. We are in marketplaces that have proven economics. So I'm hopeful that if we do diligence well at the early stage and we can form capital at the later stage, that we'll have more successful companies. Maybe there won't be as many of these gazillion-dollar unicorns, but the distribution of our successes will be more Gaussian-like, unless I had 2 massive winners and then everything went to 0. So maybe more like doubles and triples. I'm hopeful of that because of the challenge of getting these companies is daunting enough that we're going to do a lot more diligence than maybe other venture sectors do. I remember 20 plus years ago when VC first jumped into clean tech, you had venture capitalists who didn't know the difference between a carbohydrate and an electron. And so the investors were naive, the entrepreneurs were new, the access to capital was not fully flushed. Today, those 3 boxes are now checked. So I'm hopeful to what you said, that we'll have the right combination of all the stages of capital being there, entrepreneurs who now know how daunting it is and therefore are more prepared to build the right teams to succeed, and then investors like TDK Ventures and investors like us who've been through it now, right? And are going to be better board members, better investors. So I think all those things together.